Well, good morning. So last time I was sitting on the stage was Sunday night watching Game of Thrones up here. It was, if you can watch dragons flying on a 60-foot screen, I recommend it. So I'm just going to do a quick intro. Thiago, sitting on your far right, is an accomplished physicist, entrepreneur, and early-stage tech investor. He's managing director of Engage Ventures. He has a background in branding and launching products in consumer technology and B2B financial. In the middle, Brian is from Story Ventures. He previously worked at Fontanalis, the investment firm set up by Bill Ford, the executive chairman of Ford, focusing on mobility. At Story, Brian focuses on mobility investing and has an interest in everything that touches logistics and goods and people movement. James, sitting next to me, is an investor at Spark Capital, a $3 billion investment or a $3 billion assets under management firm, focused on growth stage tech investments and marketplaces and app software. So what we're going to do is, for probably the first 5 or 10 minutes, each of the panelists is going to get a chance to just give their perspective on the VC and investment market as it is right now. And then we have a few questions to dig in and move around. So we're starting with Brian, I think.
Yeah, absolutely. So as we think about kind of how to think about the macro technological shifts, what we're recognizing is that there are kind of 3 core trends that are emerging today. So one has been around for a while, but it's all around the concept of data-driven decision-making. And I think there's a story that I often go back to, which is about Sam Walton, who was the founder and CEO of Walmart. And in the 1960s, he used to actually fly planes over different geographies to look at things like traffic trends and construction trends and the movement of people. And the idea was that he was capturing kind of this proprietary data set that other people weren't using that could help inform decision making. And that's been around for a while. The second is this movement towards the digitization of information. And so whereas Sam Walton used to have to go and fly over and actually as the first person find these insights, now this information is being digitized via things like satellite imagery and ELT data and telematics data. And we're able to move from kind of a person having to capture that to machines that are able to do that. And then the third, and I think maybe the most impactful and new insight, is that we're having these improvements in artificial intelligence. And so broadly defined, artificial intelligence are basically these algorithms that allow us to derive insights from that data. And so now with this digitized kind of informational environment, we can now actually start to use artificial intelligence to derive insights from that data. And I think what's most important here is that a lot of this work used to be done manually. And what we're realizing is that businesses can supplement a lot of the human insights with these digital insights. And so I think what we'll continue to see kind of over the next few years is the shift from kind of decisions at the executive level to decisions at the executive level supplemented with kind of these AI-driven insights.
Very nice. James, what are you seeing?
Sure. So at Spark, I focus on investments at the Series B, usually starting there through later stage. So from a macro perspective, there's obviously a lot of capital that's flowing into the space, both in freight and then the venture landscape more broadly. I think across the board, you have deal sizes rising, valuations rising, and as a result of that, it's a great time to raise capital and to be a founder in the market. I think in the freight market, I think in 2014 there was $300 million-ish of venture invested, and last year was over $3 billion and continuing to grow at a rapid pace. And there are certain reasons why, kind of structurally, the freight market is potentially attractive. So in brokerage, for example, you have notionally hundreds of billions of dollars market, where the largest player, C.H. Robinson, by their own estimate, has 3 to 4% market share, and is 4 to 5 times larger, potentially, depending how you cut it, than the next largest competitor, with 20% returns on invested capital. The rest of the market in general is incredibly fragmented. So you have 14,000, I think, licensed brokers in the United States. So there's a lot of opportunity there to, A, around software tools, create more productivity gains, and B, provide more value to both shippers and carriers through technology. We think that's really exciting. On some other trends that we're seeing around telematics and interesting things you can do with data and value-added services there, I think that's only going to continue to grow. And we're consistently surprised and excited by all the greenfield that exists in the market, where beautiful software can replace pen and paper and Excel sheets and drive value for everyone involved. So it's a really exciting time to be investing in the market.
Very cool.
Yeah, so as both of them have mentioned, some of the buzzwords you hear, IoT, it's really kind of one of the major things behind a lot of the shifts that we're seeing here. I think it's within the past year, the amount of data generated is equivalent to roughly the past 50 years. So the amount of data and insight is rapidly clipping up, and there's some opportunities to use AI or some of these other things to actually distill that down and draw insight from it. But what that really means is it's creating an opportunity for a whole new class of companies that can really use that data as a competitive piece of their competitive advantage. So if you look at any market, you put the VC hat on, a large market, trucking and freight, check. Logistics, supply chain, check. That's very fragmented. You know, there's another check right there. That spells generally opportunity for kind of upstarts to come in and do some sort of consolidation, maybe not financially by, you know, kind of rolling things up, but maybe with data across the different players. And at Engage, where we really, you know, kind of have a unique insider focus and where we're very excited about, you know, kind of the industry is if you look at the modern business, there's a shift that companies are going through right now where traditionally they've been very vertically integrated and oriented, where it was most efficient to keep everything in-house and try to do it best in class and own that. But what's happening now with, you know, you kind of see it with some of the companies that have some explosion in growth is that we call it stacks. So basically you can break out a modern company into how do they build their product, how do they actually get their product and fulfill their product and get it to customer, you know, how do they maintain their employee base and really kind of build, you know, a best-in-class team. And, you know, all of these things can kind of be broken out, and there's probably a startup or some sort of company out there, just add as a service after their name, so warehousing as a service, any piece of the supply chain stack, you can just kind of add that as a service after it. We like to call it everything as a service, the kind of the new economy shift that's happening, which is just generating a huge amount of opportunity, because those that can implement these new stacks, you can't do it overnight, but in the quickest manner, you have these just huge benefits, because for the first time, each and every one of those pieces is not just a startup with two guys in a garage anymore. It's a 200-person company with tens and hundreds of millions of venture funding, building a best-in-class product that is benefiting across a whole bunch of different customers that they're working with, and gathering data from all of them and kind of creating a better product than you could ever create internally. And that's what's so interesting right now is you can actually, it's not outsourcing, because you actually have more data and you actually own the experience more than in the past. In the past, you kind of think of outsourcing, let's see, some of your development to overseas developers and everything, and you almost cringe when you're thinking about that, because you're focusing on minimizing cost or something as a large enterprise, but you're almost selling your soul, or you're giving your product out and not owning that. And there's this opportunity to both own it, but work with as-a-service players press the easy button and then focus on what your kind of core advantage is as a business.
Interesting. I was, clearly we've had a lot of demos the last few days, ton of innovation in the space. You guys are getting to see some of that as well. I was interested in, I think there are a lot of folks who are at the point where their ideas need support and they can go to market and they might be looking to a VC fund to help them get to the next stage. How do they, so a couple of questions. One is, how do they work with somebody like you? How do they find the right VC who can help them do what they may not otherwise be able to do? And then I'm also interested in, when you've made that relationship and you're interested, how do you make an investment decision? Like, how do you decide what is a good fit for you and the right place to invest?
Yeah, I would say one of the big things for me is that I think you want to be targeting investors that know what you're doing, right? If you have a first meeting and it takes about an hour for them to understand what it is your business is, it's probably very unlikely that they're going to get to an investment, because most people will be interested in learning about a sector, and so they'll actually use entrepreneurs to get educated about that category.
That's smart.
But until they get to that point, they're almost certainly not going to pull the trigger. So what I would say is, you obviously as an entrepreneur don't want to ask in advance like, hey, do you know what we're doing? But when you're having that conversation, you keep it at a high level and see the questions they ask. If they're asking the difficult questions, it actually means that they're engaging, they know what's going on and what they want to find out. If they're asking questions that are almost leading questions for you, it's probably because they don't know how to ask the hard questions. And if that's the case, you'll build out a relationship and maybe you get there over time, but it's not going to be the quickest check and it's not going to be the most helpful check. So do a little bit of homework on what they've done before, and when you're in that meeting, the harder the questions, probably the better the investor.
Yeah, I think, for myself, operating at more of the growth stage at the Series B, we have the benefit of Spark of having both kind of a seed stage focus, a Series A focus with our venture fund, and then a growth practice as well. So, a lot of what Brian described at the very early stages, I don't interface as much with. It's really helpful and nice to have relationships with folks like Thiago and Brian, who can educate me on what's going on at the very early stages of the market. I think on how we make decisions, in our group, the first criteria really is product market fit. At that stage, at the Series B, at the Series C, we're making a bet that this is going to be a category-defining business, most likely, either in an existing market or in a new category that the company is creating. And then most importantly, I guess two things is the financial metrics. Obviously, this is something that we'd like to see where there's substantial opportunity for reinvestment, so profitable unit economics, not necessarily on an aggregate cash flow or profit basis, but on a unit basis, we like to see unit profitability. And then frankly, the team. Building and scaling a team is incredibly challenging, and the proven ability for a team to recruit, hire, and retain their best talent well is incredibly important. We spend a lot of time there as well.
All right, so I'll put the entrepreneur's hat on. If I'm meeting with a venture capitalist, I love what you just mentioned. Think empathetically. In the end, if they make an investment, they're going to have to be able to talk to it, justify it. They're going to be talking to people who are probably much more educated on freight and logistics or supply chain or whatever the area you're working in. So if they're at a party, can they describe your business and can they actually defend it and really kind of maintain that excitement through those discussions? And it's going to be pretty hard to get a check until they're at that level. And if they're just seeing this for the first time, and you can kind of tell from the discussion, it's just going to be a longer process. So if you need the funding and everything there, keep on going at that. But it might be a bit of a longer process.
Yeah.
And as you're looking for potential partners or investors, I kind of equate it to getting married. You can't except with investors, actually you can't get, you really can't separate. It's a long-term relationship, and dating in that kind of analogy, it's terrible, I should stop right now, but you don't want to jump in too quickly, and you really want to just make sure that you're aligned and getting the right fit. And if, I kind of put a corporate hat on, I think from the venture capital perspective of looking at tech startups, there's thousands of them out there, everything. You might be getting referrals from friends and neighbors and everything about the hot new startup that you absolutely have to use. It's really important to obviously make sure the product is solving some need for you. That's the easy part, but what we see with a lot of our enterprise partners is you almost have to set that aside and try to look at the opportunity more from a venture capital hat. And that could also involve talking to one of us or a VC to kind of give you some third-party perspectives. But you want to make sure that the company is going to exist in 6 months. It can have the best product in the world, but you kind of have to make sure some of the other things are there. Is a fundable company for other reasons that might not be apparent on the surface, because the best founders are good sellers.
Fergus, just to get to the second part of your question, which is how do we actually write that check, right? What gets us there? I think one of the big things is that from a venture perspective, something that I think a lot of people underappreciate is that entrepreneurs can build good businesses that might just not be the right fit for venture-backed businesses, right? So there are tons of businesses that should never raise capital and should, off of cash flow, continue to reinvest in their business and build and own 100% of that business. I think what we're looking for are businesses that can go from the initial product to a full-fledged business or platform or whatever that might be, right? Which is every initial business, for the most part, is a single product that they're selling into the market. And almost always that product has a set TAM, which is tens of millions of dollars in revenue. And the reality is, like, as a seed investor, Series A, Series B, that's good, but that's not actually the outcome we're looking for. We're looking for them to be able to parlay that product into a massive business. And so when you think about it, I think it's very important to make sure you're aligned in what you're trying to build, which is if you're really happy building a product business that's going to generate 10, 20, $30 million in revenue, that's amazing. Probably not right for a venture fund. If you're going to build that with an idea that there's all these other verticals that you can expand into over time as you build that moat, that's probably when the investor will get excited. But it's a way bigger vision, it's way more time, and so you need to be really ready to commit to that.
Yeah, that's why you hear the line, is it a large and growing market, right? So that's just a core piece of it. The rule of thumb I like to use sometimes, if you're talking to a venture fund, if you look them up and you see that they're $1 billion fund, or you look at the dollars under management, finger in the wind, that's probably the minimum bar they're kind of expecting you to sell your company at. So if you're talking to large $1 billion funds, their model just does not work unless you are shooting for that multi-billion-dollar exit. So just, it's a pure matter of alignment. A lot of that stuff can just be done with a quick search before jumping into a meeting.
One of the ideas, Thiago, that you touched on was market expertise. We all imagine tech startups and a garage in Silicon Valley and that sort of archetype, but that's not quite the case anymore. I'm really intrigued by the thesis of Steve Case and the rise of the rest to find these pockets away from the coast, away from the big cities. How do you guys see that? How's that evolving? How do you embrace that kind of concept too?
Yeah, I think it's a really exciting time to build a tech company anywhere. But what we've seen even in companies we're evaluating, or even our own portfolio companies, is that the Bay Area, it's incredibly competitive for talent. It's incredibly competitive, particularly for engineering talent, and it's really expensive. There are certainly trade-offs to being in the Valley versus somewhere else, but I think with the proliferation of tools like Slack and Zoom and others that make kind of multi-office or fully distributed teams more viable, I think we'll continue to see more of that. And frankly, there's a lot of great talent in everywhere. So in Atlanta, you have great hubs here like Georgia Tech. FreightWaves is in Chattanooga with amazing talent. And this is true of many other places in the country. So I'm excited to spend more time in places, frankly, outside of the Bay Area and think that there will be massive opportunity, and that there's actually advantages that come from being outside of the Bay Area.
Yeah, I think for myself, one of the interesting things is, so I think nothing but the best about the West Coast and Silicon Valley in terms of what they've created. Generally what I've seen on the West Coast is that folks are building technology and then trying to apply it to business cases. And it's worked historically, especially for the large tech companies. I think, so we're in New York and we focus on the Northeast and Midwest, and I think what we're most excited by is that usually we're finding entrepreneurs that have industry expertise, that know the business they want to create and are applying technology to that business. And so I think it makes for far more commercializable solutions. And so I think like there's going to be, the best engineers still do exist on the West Coast and it is spreading, but if you're thinking about how to create large-scale businesses, the people you really need are the industry experts that know how to disrupt construction and logistics and transportation. And so it's finding those people that are smart enough and savvy enough to know that technology is changing and you can introduce that into market to build these really high-quality solutions. And honestly, that's what we prefer to invest in.
I'd say about 90% of our portfolio is not in the Valley. We do make some occasional kind of exceptions there for the right opportunity. I think it is kind of a competitive advantage. So before wearing the Engage Ventures hat, I was wearing the founder hat, and based in Ann Arbor, Michigan, of all places, and kind of looked at it as just a really unique advantage from sourcing really great engineers and talent out of a university that I could throw a rock and hit U of M. Not even a U of M fan, didn't go there, by the way, for the room. But so, it's one of those things where at the time, the thesis was, hey, if we can actually raise the capital needed to kind of tackle the strategy that we're going after, it's going to be for the best. And we can kind of retain and build a world-class team here. And it definitely worked out that way. It was, and it's changing even more so now, where a lot of venture funds, even the past kind of couple years, have really been looking elsewhere outside of just that concentrated area for opportunities, because there's a lot of stuff kind of popping up, opportunities. Duo out of Ann Arbor there just sold to Cisco for over, it was like $2.5 billion or so. So just kind of proving out that it's not just the $100 million exit that you can expect outside of some of these core areas. It's large exits as well.
I've been thinking about something that, James, you were talking about right at the top, just about valuations going up. I remember, I don't know, end of last year, starting to think something's going to happen, middle of 19, things are going to go south, there's going to be an event, and it sure doesn't feel like that now. It's confidence is high, there's a lot of money. Is the shoe going to drop? Where's this going?
I can't claim to be an expert on market timing. I think valuations are rising in the private and the public markets. I think with interest rates this low, it makes sense in some cases, and others maybe not as much. But timing that, I really don't have a strong point of view on. But what I will say is that for businesses that we evaluate, we want them to be able to survive through any kind of correction or market cycle. So when we evaluate opportunities, we look at multiples over a long period of time, and run a lot of sensitivity analyses about what that might look like. But then also in our companies, if there is a real market correction, that they're well capitalized enough to be able to kind of weather the storm and come out much stronger on the other side.
Yeah. I think, to James' point, like, there's no way to know, right? And I wish I knew, but I definitely don't know. I think what we preach to entrepreneurs, especially the entrepreneurs we invest in, is that there are real business fundamentals, and the reason to raise capital is to accelerate those business fundamentals, right? And so there are some companies that are raising $50 million off of zero revenue, and they're putting themselves in significant risk that if there's a market correction, they've overcapitalized a business that cannot possibly grow into the fundamentals it needs to be to justify future capital. And so in an environment where there is a lot of uncertainty, what I try to tell entrepreneurs is capital is there if needed, but you should use it only if you actually can put that money to use to fundamentally grow the value of your business past whatever that capital is. And so what I generally say is think about if you're raising $5 million, does that generate in your mind $10+ million of enterprise value for your business? If it doesn't, you shouldn't be raising that capital. And so I think it's important just to be thoughtful about why you're raising the money so that if you don't have access to the capital markets, you haven't kind of overextended yourself and you can sustain through that downturn and come out the other side in a stronger position, because a lot of people actually mismanage capital.
Yeah. No, it's a funny one too, because there's not all VCs are good investors, right? So, in fact, in any sort of profession, roughly what, half are not so great, right? So just because you can doesn't mean you should. So going through some of those filters and everything and evaluating if you actually should raise that capital is a big and important one. And then for those in the room that are kind of wearing the corporate hat, you know, a lot of times, you know, if you look at some of the firms that are known for the specific segment or just have that stronger brand name, it's imperfect, but sometimes that is, you know, kind of a signal at least of smart capital going into the business. Yeah. Versus just pure dollars, because dollars isn't always the right indicator. But yeah, going back to the core question of valuation, it's certainly gone up at a steady clip here and everything, and we'll see if there's a correction. But you know, founders, raise your money now. I don't know. We'll see what kind of happens over the next year or so. It might not be dramatic, but start kind of moving the other way.
Great. Well, sadly, time has caught up with us. Thank you, panel, very much for participating.
Thanks for having me.
Thanks.